Good evening, all. On behalf of Department of Commerce, Soka Ikeda College of Arts and Science for Women, Chennai welcomes you all for this webinar program. Our Secretary, Madam Mrs. Kokilam Kumanan, our Chairman, Sir Dr. Sethu Kumanan, and our Principal, Madam Dr. Shamshat, Madam, welcomes you all and convey their best wishes for this program in a smooth manner. Soka Ikeda College of Arts and Science for Women has gloriously topped the 21st year with its many accolades and achievements since its inception in the year 2000. The college has emerged as a pioneer institution for women's education in the neighborhood. The Institution of Excellence Award conferred by the Indian Council of Gandhian Studies New Delhi adds glory to the success saga of the institution in recognition of extraordinary service rendered by the college in the field of women's education and empowerment. To promote development of research and other activities, a memorandum of understanding was signed with Soka University, Japan in the year 2009, which facilitates students' academic exchange program. Our chairman, Dr. Sethu Kumaran, educationalist, philanthropist, and poet, started this college with the smooth-line mission of empowering the rural women as envisioned by his mentor, Dr. Ikeda. Our chairman, Dr. Sethu Kumaran, is a proud recipient of many awards. Now it's time to introduce the two young and eminent personalities. It's nothing. Dr. CA Abhishek Murali and CA Divya Abhishek Murali. Hello, sir. Dr. CA Abhishek Murali is a practicing chartered accountant in Chennai who is currently the partner of Mrs. Victor Grace and Co., Chartered Accountant Secretary of SIRC of ICAI 2020-21. He is also an All India first rank holder in CIMA strategy examination and an All India 17th rank in CIMA final education examination. He also secured the All India 5th rank in international taxation examination. He is the youngest elected regional council member of the Southern Indian Regional Council of the Institute of Chartered Accountants of India by securing the highest number of votes. He is an expert in direct taxation, international taxation, litigation, appeals, valuation. Abhishek Murali sir has conducted and spoken at more than 500 seminars on direct taxes in 1 year. He has nominated as chairperson for many committees. He has written 5 books and published more articles. Too, he is a good player too. I have shortlisted his laurels due to the time constraint. CA Divya Abhishek is a practicing chartered accountant in Chennai. She is an All India 46th rank holder in CA final examination and All India 23rd rank in ICSI examination. She also secured the All India 4th rank in International Taxation examination. Congrats, ma'am. CA Abhishek, Divya Abhishek is the youngest ever president of Inner Club of Madras, Next Gen, and she is a secretary of the Women Professional Empowerment of the India. Forum of India. She is an expert in audit, company law, cross-border transaction, and international taxation. She was also selected to a team constituted as a special task force dealing impact of Companies Act interest and young, which also involved presentation and discussion at various MNCs. She is a partner of Sukumar and Association and played an instrumental role in the corporate law and international tax division of the firm and leads a team of 78 members under her leadership. Divya Abhishek has nominated in many committees constituted by SIRC. She is also actively involved in career counseling and enhancing awareness amongst all girl children. She is a keen women social activist with a passionate professional focus on women empowerment and campaigns for the upliftment of a girl child. It's a pleasure to be with us today. Welcome you both of you, sir and madam. Welcome, sir. I
Thank
now
you,
hand
ma'am.
over.
Thank you.
A very good afternoon to one and all. As the economy is picking up, we are going back to a state of normalcy. At this juncture, it's important from a tax angle for you to take two steps. The first step is for the year ended 31st March 2020, Ensure that you have paid your taxes on time. Even though the filing of return of income has been extended till November, if you pay your taxes earlier and on time, you will not incur the additional interest charges. The second step is for those who are in employment, I'm sure by now you would have gotten an email from your employer asking you to submit investment proofs, not just to salary, but any other income that you will earn for the year ended 31st March 2021. Now, in this backdrop, it's important for you to know what are these incomes. There are five heads of income which I have listed in the slide, which forms the bedrock of income tax. Income from salaries, this is for those who are in employment and earning salary. Income from house property, if you own a house, you'll be receiving rent for it. Profit or gains from business or profession, if you have your own business or profession, it will get taxed here. Capital gains, if you are selling any asset, any land, building, it will come under this. The last clause being income from other sources, typically your fixed deposit interest and various other incomes. Now, for an individual, what will be typically relevant will be your three heads: income from salaries, house property, and other sources. Bare minimal, you will have something from these heads. We have already covered income from salaries in our YouTube channel. So today, our primal focus will be on income from house property and income from other sources. Now, what is this income from house property? You may own a house property or you may dream and be in the process of trying to save money to own a house property. Once you own that property, you will let it out. You might get rental income from it, or you yourself will decide to stay in it. There are certain benefits, conditions, and requirements under the Income Tax Act that you need to comply with when you earn income from house property. So, I am going to cover the basic provisions under this head of income along with some tax saving opportunities which can be availed as per the Act. Before we delve into what are these incomes that is going to be taxed, let us understand what are the types of house property. First and foremost, we call this self occupied. That means you become the owner of a house property. You yourself will reside with your family in that house property. In such a case, it is a self occupied property. Say, because of employment, you need to transfer to another city. So the house property that you bought, say in Chennai, will be vacant for the period because you will have to transfer to some other city for the sake of employment. Even during such times, it will still be considered as if it is a self occupied property. The next case is a let out property. What is this? You may own a property, you decide to let it out for rent to a tenant. You will get rental income on a month on month basis. This comes under let out property. There's a third special scenario called deemed to be let out property, which is you may have a house property even though you don't let it out, you don't find a tenant to stay in that house property. For the purpose of this section, it will be considered as deemed to be let out. The last being, if you are in the business of leasing house properties, it will fall under property held as stock in trade. I will be explaining this in detail through the course of the presentation. What is this house property? What is the basis of this charge? We may assume, supposing you get rent credits into your bank account on a monthly basis, you offer that to tax. Supposing you yourself decide to stay self-occupied property, there's no income that you are going to get. So no reason for you to pay tax on it or offer it to tax. Wait a minute. Let us understand what the Bare Act says. The Bare Act says income from annual value of the property. That means whether you get credit or not, this is the only head of income that taxes on notional basis. That is irrespective of you earning the income to your credit or not, you will still have to comply with the provisions of this section and understand if it's taxable. Even though the topic says house property, it does not matter for it to be a residential property. You can even let out your house property for a commercial purpose, say a mall, shopping complex, movie theater, any nature, it will come under this section. I am not going to read out the definition. It is a short definition of what is the basis of charge under section 22. But let us understand the important conditions in this definition. While there are multiple interpretations, let us touch upon the important ones and the practical applicability of these. Typically, you should have a building and land appurtenant thereto. You should be an owner of that property. There are 6 special cases where you can be deemed owner. That means even though you are not owner, you will be deemed as an owner for the purpose of this section. If you use it for any purpose, it comes under this, except for purpose of business or profession. The last being composite rent. Let us take some practical examples. You decide to buy a house property in a big complex, renowned constructor. The house apartment comes with garage, play area, your own parking space. The income that you will earn by letting out this house property to some tenant will squarely be taxed under this section. Let us take another example. You are buying a land. You decide that you want to construct your own house, but it is taking some time. So what you do, let me make some money. That vacant land, you decide to let it out on rent for somebody to use as their parking spot or whatever reason. Whatever reason. Now this land will not be taxed as house property because the definition clearly says building and land appurtenant thereto. The land has to be an indivisible part of the building. It should come with the building. Only a plain land, plain immovable property will not come under the provisions of income from house property. It specifically says it has to be a house property. A building, a superstructure has to be constructed over it. Let us take a third example. What happens is the land you do not own, you are taking it on lease. You build your own house on it, it is complete. That house you give it out on rent. In this scenario, it is a combination of first 2 scenarios that I said. Will it be taxable in this section? The answer is yes. You need to be owner of the building in order to come under this section. The special scenario where I said deemed owner is supposing you transfer this property to your wife or to your minor children without any consideration. That is, you don't collect any sale value for a reason otherwise than to live apart. In such a case, the Act will still consider you to be the owner. There are several other cases where you will be considered as a deemed owner. Now, it is interesting that we can learn the provisions of the Act even from some movies. What you see on the screen is from the famous movie Unbeva, famous MGR movie. What happens in this movie? MGR is the owner of a big house. He goes abroad. So for 2 years, he gives the house to his caretaker and asks him to take care of the house. Nagesh, as a caretaker, what he does, he finds some other couple. He makes a move into the house and he collects rent from this. Now a question will arise. Nagesh has to pay tax on the house property. What he has done, he has given out a house property. He is collecting rent from it. It is not used for any other purpose. The answer to this lies in the precondition itself. In order to be taxed under house property, you need to be the owner of the property. In this scenario, Nagesh is not the owner. However, he still needs to pay tax on the rent that he is collecting from them. But he has to pay tax in income from other sources. Now you may again ask me, what is the big difference? Instead of paying tax from income from house property, I still have to pay tax from other sources in my hand. I don't, it doesn't matter which head of income I have to pay. I'm still going to be paying income tax. Wait a minute. If you are the owner of the property and if you have to pay tax under the heading house property, you get certain special deductions and benefits. So let us understand, in order to be taxed under house property, what are these benefits? In my screen, you will typically see two things. One is the self-occupied property, second is the let-out property. The starting point for both computation is going to be a gross annual value. What is it? In layman's simple terms, your gross annual value is going to be higher of expected value from the property or the actual rent you receive, whichever is more. As I already told you, house property is a special provision where taxation happens on notional basis. What is this expected rent? Typically, if you own a house and if you have to decide what rent you have to charge for your tenant, what will you do? You will walk down the street, knock the door in few houses, find out what is the rent they are going to offer to their tenants, and then you decide your rent. The Income Tax Act also imputes this. It says, in order to determine the expected rent of a property, find out what is the fair rent, which is the rent charged by a similar property in the same location. Some cases, you might also have a municipal value. We are all paying property taxes. Municipality will come to your property and determine the value of that property on the basis of which it will say this is the tax. So whichever is higher, fair rent or municipal value, you have to take that as your expected rent. There is one more condition. Some cases will get covered under Rent Control Act. Take the state of Maharashtra. It is covered under Rent Control Act, where over and above the above two criteria, they will determine something called as a standard rent. Above that rent, you cannot charge. So, your expected rent will be subject to a limit of a standard rent if there is. That is one bucket. The next bucket is the actual rent. Now you've decided your rent, you have your tenant staying. You decide to charge him 12,000 per month. The expected rent after the above condition becomes 1,20,000. So if you're charging 12,000 per month, you are going to get 1,44,000. Whichever is higher, which is 1,44,000, becomes your gross annual value. Now supposing because of some difficulty, your tenant leaves your property by February. He stays only for 10 months. Last 2 months he is not able to stay. For no fault of yours, this property of yours now becomes vacant. Go back. Now what will you say? Expected rent is a little higher than what you're actually going to get. That gives an exception. Only in the case of a vacancy, your actual rent is still higher on a monthly basis as compared to your expected rent. You can avail this benefit and still take only the actual rent. So, only in the event where your property becomes vacant, then you can avail this benefit. Now, let us go back to the computation. If you are occupying the property on your own, then your gross annual value is going to be nil. Why? Because you are not going to pay rent to yourself. In the case of let out property, you will arrive at the gross annual value. You are allowed a deduction in the case of let out property for your municipal taxes, provided you follow two conditions. One, the municipal tax has to actually be paid by you. It is not enough if it is payable. Second, it has to be paid by the owner himself. It cannot be a case where your tenant is paying and you're reimbursing your tenant. You will arrive at your net annual value. This benefit naturally is not allowed in self-occupied property. The most critical component is the deductions under Section 24 that is allowed for house property. First being a flat standard deduction of 30% is allowed in the case of let out property. Whether you incur any expenditure for brokerage, anything, it is allowing you a 30% deduction. I'll go back to my movie example. You asked what is the difference? This is the difference. If you get taxed on a house property, the benefit that you can claim is far higher. If you get taxed under income from other sources, you have to pay full value tax on the gross amount. You cannot take the standard deduction benefit. The next critical deduction is the interest on borrowing capital, which I will cover. Once you finish this computation, you arrive at your net value. Ideally, if you are someone who owns, say, three properties, one you let out, two you consider self occupied. A very important amendment happened in financial year 2019-20. Earlier, they allowed you to have only one property as self occupied. So even if you say, I have one more property that I'm not using, it is vacant, even though that is the case, there will be notional rent which they will arrive at using the gross annual value provision, and you will still have to pay tax on both the property that you didn't let out and the property which you let out. There's been a significant amendment because what happened was somebody bought a house, say in Chennai, subsequently, because of employment not under his control, he has to move bag and baggage to, say, Delhi. He'll again buy a house in Delhi. So the government wanted to minimize the hardship. So from financial year 1920, that is for 31/3/20, when you file your return, you'll have a significant benefit. If you own multiple properties, up to two properties, you can take your gross annual value as nil. Comes to the last provision, which will be your interest on borrowed capital. Typically, to buy a house, we would have taken house loan. Now, the Act recognizes both loan you take from a bank or loan you take from a relative or friend. The nature of the loan should be taken for the home loan. It has a different provision. If it is for a let out property, any amount of interest you pay, you can take as a deduction. But if it's a self occupied property, then there are two things that you need to consider. If you have got a home loan for acquisition or construction of a new house property, this loan has to be taken after 1/4/1999 and the construction has to be finished within the period of 5 years. If you satisfy these conditions, you can take up to a limit of 2 lakhs as your deduction. There is a cap. Irrespective, even if you pay interest of 5 lakhs, there's a cap of maximum of 2 lakhs that you can take. Supposing you have not taken a loan for construction, but you're taking it for repair, renewal, other minor things you need for your house. In such a case, you can take only a deduction of 30,000 rupees. I go back. I said two conditions have to be satisfied. Supposing you do not satisfy those two conditions, your construction takes 6 years. Then you can only avail the benefit of 30,000 rupees and not the 2 lakh rupees. This is on the interest side. The government has also given benefit for the principal amount that you will repay under Section 80C, where a total limit of 1,50,000 is given. This will also include your stamp duty, registration charge, everything will be included under this provision. Over and above this, in order to make housing affordable, not to encourage people to have their own houses, two new provisions have been introduced. One is Section 80EE, which was reintroduced in financial year 16-17. Certain conditions, your loan should be less than 35 lakhs, value of your property should be less than 50 lakhs, then up to rupees 50,000 you can avail this. Only rider in this, you cannot take deduction under Section 24, which is the 2 lakh, the 30,000 you cannot take. The new amendment, which is beneficial to many, is what has come now. When a loan has been sanctioned during financial year 1920, and the stamp value of this property for which the loan is sanctioned is less than 45 lakhs, and you do not own any other house property, this is your first house that you're buying and the loan you are taking, then Up to a limit of 1,50,000, you are allowed to take a deduction. Supposing you are a co-owner, you and your sister decide to buy a house property, then each of you can take a benefit from this section. So the benefits of availing, when I said you can plan your taxes, this is what I mean. There are so many provisions that are available at your disposal to avail and take benefit from. The next provision is an interesting one, which is also very relevant to the times we are living in. Let me first explain what it is. One is a specific provision of unrealized rent. You are the landlord, you have given it to an employee who's working in a company. Now, for whatever reason, he is not able to pay your rent. He's asking for time. It is not beneficial for you. So what will you do? If you have taken the following steps, then you can avail the benefit of deduction. One, the tenancy should be bona fide. There should be a proper agreement. You have taken steps to make the tenant vacate. If he is not vacating, then you have taken some legal proceedings, or you have proof to show that you have taken them. You have not sent him to any other property you own. If you follow all these conditions, then that unrealized rent you can take as a deduction from the actual rent. It is allowed. The next case. Typically, in your rental agreement, there will be a clause called escalation clause, where they will say every year rent will be escalated by 10%. Your tenant might be causing some problems. He will say, I cannot pay any escalation. Now, suddenly, after 2 years, he pays you this arrear amount. That is that escalation amount of 5% or whatever that he didn't pay before, he pays you. When you receive that amount, that will be liable to tax. These are special conditions. There's an amendment again in assessment year 17-18 where they clubbed both of this and said any amount to the extent which was not included in the annual value earlier will be taxed in the year of receipt. Why am I saying these provisions are relevant now? We are living in difficult times with corona, so many issues. Either your tenant is staying in your house but he is not able to pay you the rent, or he has gone back to his hometown, he's vacated, and you've still not received rent. Earlier, we discussed house property is taxed on notional basis. That is, even though you don't receive that rent, based on what is estimated as fair value of the property, you will still have to pay rent. So at this juncture, even the state government is saying you cannot take steps to evict your rent or demand payment for 3 months. So the first bucket of it being an unrealized rent where you satisfy all these conditions will not apply to you. In this scenario, if you still don't want to if you want to avail the benefit and you don't want to offer to tax the rent that you have not even received, you need to take one critical step. First, understand if the original agreement that you signed with your tenant has the force majeure clause. Force majeure is act of God, where you can say that because of corona, it is an act of God, you did not foresee it, and hence you will still be allowed. Supposing your original agreement does not have this clause, then on an immediate basis, enter into a supplementary agreement with your tenant where you inform him that because of corona, he is not able to pay you the rent, owing to which you will not be able to offer the same to tax. You have a clear supplementary agreement reducing your overall rent receipt for the year, and you insulate yourself from future proceedings. The next critical point is if you co-own a property with somebody, say you and your wife decide to buy a house together. In such a case, if both of your share is proportionate and ascertainable, that is, you know how much is your share and how much your wife's share. In such a scenario, you will still be taxed under income from house property. In the event where you're not able to ascertain, you will not be taxed under this, but you will be going to income from other sources. Another point, typically these days, co-working spaces have become very popular. So a lot of IT companies, what they're doing, You charge me on seat basis. You take the furniture, chair, seat, everything. You pay me for one seat 30,000. Based on the number of seats you want, you pay me the money. Now, in such a scenario, you are getting a composite rent between occupying the space and the assets that come with it. If you are not able to segregate the basis of charge, if the landlord does not tell you pay 10,000 for taking the empty space, 10,000 for the computers, furniture, and all the other accessories. If you are not able to segregate, then the entire amount will be taxed under income from other sources. So it is very clear to us, unless it is in the nature of a house property, it cannot be taxed under this section. Certain exemptions are also provided in this. Supposing you take a house property for a charitable purpose, for approving scientific research, khadi and village, agricultural purpose, political party, in all these cases, even though the income is going to be in the nature of a house property, it is completely exempt under section 10. Let us take some examples before I conclude. First being, you are staying in a house, self occupied for 6 months. Suddenly, you need to move. So you decide to let out this house on rent for the balance 6 months. Now, in this scenario, what is it going to be considered as? Self occupied or let out? The Act has clearly said this is going to be considered as a let out property. So you cannot take your gross annual value as nil, but you should take the actual rent you have received. Another scenario, you live in a house, you occupy the ground floor. First floor, you decide to lease it out or you use it for your own business or profession. In this case, the Act says to the extent of you occupying the ground floor, you can take that part as self occupied, and the first floor you can take as let out. Thus, whatever deductions you can claim it on a proportionate basis. Third scenario, in order to buy the house, you would have definitely paid brokerage, heavy amounts you'll be paying. In this case, can you take this amount as a deduction? The answer is no. Very, very stringent provisions. Only the deductions that is allowed in the Act. Already they are giving you 30% standard deduction. The logic is everything will get covered in that itself. You cannot take any other additional expenses you spend for getting that property. The last provision being property held as stock in trade. Builders were facing a lot of difficulties because they would have finished construction, but they would have not got the completion certificate. The whole process, as you know, will take some years. What the department started doing, they started imputing, saying you have to pay notional tax because your property is completed, the fair value in that area is high. So take it as a notional rent, even though you don't have anyone, you pay. So a landmark clarification and a new provision has come in section 23(5), which is with effect from assessment year 1819 up to 1 year from the end of the financial year in which you get the completion certificate, you can assume that the gross annual value of that property will be nil. So, in this backdrop, we have completed the portion relating to house property. We will be taking questions from both these sections in the end of our presentation. I will now hand over to the next speaker, Abhishek. Thank you.
A very good afternoon to all the viewers who are joined in today. It gives me great privilege and pride in addressing on behalf of this very, very prestigious college on the very, very important topics, which is taxation for house property and taxation of income from other sources. So since house property is already covered, I'll focus on taxation of income from other sources. As the previous speaker rightly said, there are five heads of income. And any income that you have, all of it have to go into these five heads. Just for reminding, I'll quickly update the heads. Income from salary, income from house property, income from business or profit and gains from business and provision, capital gains, and then income from other sources. Now, the first four heads are very, very clear. You know what and all is going to be part of it from reading the title itself. But income from other sources is such a wide ambit. What does this mean, income from other sources? Just like the name suggests, it is a residuary criteria. Any income that is not chargeable under other heads of income has to be taxed under income from other sources. So it is almost an afterthought. In fact, people say this is the residuary section. Whatever is not that will come here, it is not that important. That was the opinion which was shared on basis of income from other sources. But let me tell you, there are so many amendments and so many changes which have impacted this income from other sources. All of a sudden, this has become a very, very important provision, not just for the highest level of people, but for people who are salaried persons, people who are doing business, people who are doing neither, they just have investments and they're living. For all of them, income from other sources is playing a very, very critical role. So let us understand what is this income from other sources. And I've selected certain critical elements that will affect all of us and some interesting decisions that will be impacting how you tax your income from other sources. So these are the broad examples of what usually comes in your income from other sources. You are receiving any dividend from your mutual fund or from your shares, that will come under income from other sources. You are receiving interest. Maybe you have a PPF account, maybe you have an FD account, maybe you have a savings bank account. All of this, the interest that you get from that will be taxed under the head income from other sources. You get any gift, it's a very important point. If you're getting any gift, that is also taxable. How, when, what is exempt, I will get to it. Finally, game winnings or gambling. If you're doing any gambling, that is also taxable. We must remember something which is very intriguing about the Income Tax Act is whatever income that you have, you should bring it to tax. You might have a feeling, what is this gambling? It is illegal. How can we bring it? It's not correct. Maybe if you're a thief, you're a robber, you're going and stealing somebody's wallet, and out of that wallet, you're getting 10,000 rupees. You have a regular business. Other than that, you have this burglary business you're doing very successfully. You're making around 1 lakh rupees from that. Do you have to offer it to tax? As far as income tax is concerned, whatever nature of business your income you're having, you have to offer it to tax. So therefore, you must put income from other sources, income earned from thieving, from burglary, after stealing wallets, 1 lakh rupees, like that you have to offer. So therefore, game winnings that you're having from competition, even if it is gambling, you must offer it under the head income from other sources. Let's start off with the first point, dividend income. What do we know about dividend income? I'm holding shares, I'm holding mutual funds, I'm earning some dividends out of this. There are two aspects when you have shares or when you have mutual funds. One is the capital appreciation. Capital appreciation. I bought Reliance shares in the early 1990s. I bought it at 100 rupees. Today it is trading at 1400 rupees. Therefore, 1300 rupees, that difference, that increase in the value is called a capital appreciation. So when you sell it, that capital appreciation will be brought to tax under capital gains. Now, what if you receive a dividend from the company? A dividend means the company is distributing its profit to its shareholders. So it's a distribution of either the profits or the assets of the company to the shareholders. This will be taxed under income from other sources. So till the current year, that is financial year 2020 to 21, dividends, there was exemption in some form or the other. In fact, till 2 years back, your entire dividend income that you're earning from listed company shares was entirely exempt, completely exempt. However, in the last 2 years, up to 10 lakhs exemption was given. Up to 10 lakhs, you don't have to pay tax. After 10 lakhs, you pay tax at the rate of 10% enough. But from this year onwards, financial year 2021 onwards, the dividend distribution tax has been removed. What is dividend distribution tax? Erstwhile, the government took a stand. I am Reliance. I am distributing dividend to my shareholders. How many shareholders I have? 20,000, 30,000, sometimes lakhs also. So I have 30,000 shareholders. I am distributing some dividend to the 30,000 shareholders. Now, the question arose, how do I tax this dividend? They took a stand. If I have to go and inspect 30,000 people, whether they are correctly offering it to their income or not, it will be difficult. Instead, why don't I tax Reliance, the company that's distributing the dividend? I will tax it at that time itself so that the rest of the people they can say exempt. Worst come worst, what will happen? If they have to get 100 rupees dividend, after the tax, whatever Reliance is paying on that dividend, the balance they will get. And that balance anyway is not taxable for them, so they can be happy. So this was the thought process that the government had when they had this dividend distribution tax. But this year, the government have taken a conscious decision. They have said that we will abolish the dividend distribution tax. That means Reliance, who was distributing that dividend to 30,000 people, they no longer have to pay tax on that dividend. Instead, government is saying that each individual pay the tax. So I am a shareholder of Reliance. I am getting dividend. I have to pay tax. Now you can think that yes, it makes a lot of sense. This is perfectly normal. But what we have to remember is, as individual shareholders for the company, excellent. Earlier they were paying 18% dividend distribution tax. Now they don't have to pay that dividend distribution tax. They can distribute it freely. But if you are that shareholder, you are that individual shareholder. Earlier, you were first of all you were exempt completely. Next, they brought saying up to 10 lakhs exempt. Beyond that, 10% you pay enough. But now, what they are saying is that dividend that you receive will be taxable at your slab rate. So, if my income is at a high rate of tax, I am earning 10 lakhs rupees, then it is taxable at 30%. I am earning maybe 50 lakhs or more than 1 crore I'm earning as my annual income, then my tax goes to the highest slab rate of more than 42% with my super surcharge. And this dividend income is also going to be taxed at the same rate. Whereas till last year, it was taxed maximum at 10%. So you see the change. You are paying more than 20 to 30% more tax on that same income. You were paying 10% before. Now you are going to be paying close to 42% or more than 30% on that same dividend income. No exemptions allowed. So this is the latest critical amendment that is going to impact all of us. If you get dividend in any form, it is now fully taxable at your regular income tax rate. You don't get the beneficial tax rate of 10%. There will also be a TDS. When the company distributes that dividend, if your dividend is more than 5,000 rupees, they will deduct TDS on that distributed dividend. So then what happened is, many intelligent people, what they did was, when this taxation of dividend was announced, they came up with a concept saying, yes, if we distribute the assets or if we distribute the profits, then it is taxable both in the hands of the company as dividend distribution tax and in the hands of the individual company director or the shareholder also. So what they were thinking, okay, it is a closely held company. How can we plan? How can we plan such that we don't have to pay tax? Let's do something. Why don't we give a loan to the director? Why don't we give a loan to the shareholder? Saying that it is a loan given, it is not dividend. But that shareholder, he need not pay back that loan to the company. You will tell, take 100 years for repayment of loan. That is more than that person's lifetime itself. Very intelligent structuring. When government come and ask, they will say, no, it is not a dividend. I only given a loan. He has to pay it back to me. The company will say this and they try to escape. So in order to curb these inappropriate transactions, which are done with the intention of defrauding the government and defrauding the provisions of the act, just to defeat the provisions only, these sort of things came. So they conceptualized a section called deemed dividend. Therefore, like the example I gave you, in certain situations where the company gives an advance, where the company gives a loan to the shareholder, then it will still be considered to be a dividend, even though it is in the nature of a loan. Those conditions I have tabulated here, where the shareholder owns more than 10% of the voting power. If he takes a loan, whether genuinely it is a loan or whether it is a transaction as if it is a dividend but shaped like a loan, then also you have to pay the dividend on that. It will be considered to be a deemed dividend. Similarly, I am a shareholder of the company, and I am also a partner in a firm where I have more than 50% share in the profit. What I am telling the company, you don't loan to me because deemed dividend. Instead, you loan to my partnership firm. I'll be happy. That also they are curbing. Where to a firm or a HUF or any other company where the member has a substantial interest of more than 20%, then that also will become taxable as deemed dividend. Similarly, to any other person on behalf of the shareholder I am giving, that will also be considered to be a deemed dividend. Let's see some very peculiar cases that have happened in the past. One company, they wanted to give a loan to the director because they wanted to give dividend. He said, you give it in the form of loan. Then they realized, no, this deemed dividend provision is there. What you do is you give the loan to the company driver. Give the loan to the company driver. He does not hold any shares in the company. He is not a shareholder. So therefore, it will not be dividend. So you give a loan to him. So they gave a loan to the driver. Then he told the driver, you give a loan to me. The same amount he took the loan from the driver. When department came and asked, he said, no, the company has given loan to the driver. Driver has given a loan to me. Company has not given me anything. So therefore, it is not deemed dividend. But this is when they lifted the veil. The Supreme Court, in the case of Alagasundaram Chettiar versus CIT, they said that it will still be considered to be a deemed dividend. Then one other director in another case, he said, sir, yes, I took a loan, but in 23 days I repaid it back. It is not in the form of dividend. I've taken a loan, I've given it back in such a short time. So clearly, I'm not trying to make it seem like it's a dividend. In earlier cases, the loan you have given for 100 years' time. So naturally, he is trying to say that it is a dividend only. He is simply covering it up saying a loan. But in my case, I take a loan, but in 23 days, I've returned it. Despite that, whether you are returning it in 3 days, 23 days, 23 years, the government does not care. If you have received it and you trigger that limits that I told you, 10% if you're a shareholder, 20% if you're interested in some other concern, in both cases, it will still be taxable as a deemed dividend, whether it is genuine or ingenuine or fraud, whatever it is taxable. And this was determined in Taurulata Sham versus CIT, a Supreme Court decision again. Let's move on to the next important criteria. Taxation of gift. Many of us receive gifts on a day-to-day basis on occasions like a wedding, occasions like birthday, occasions such as Deepavali. So what is the taxability of a gift? Now earlier, the provisions of the Act back in 1997 or 1998, till then there was something called the gift tax. So whenever someone is giving a gift, the donor of the gift, the person who is giving the gift, he will be subject to a tax called a gift tax. Then in 97, 98, the government felt we should no longer have this separate gift tax. They said we are repealing it, or rather, they said we are putting it on hold. They did not abolish that gift tax act. They put it on hold and they said later on we will tax it in the income tax act, and they left it at that. Then they didn't introduce it in the income tax act for another 5 or 6 years. 6 years later, they brought the first provision, the small taxation in the for taxation of gift, nothing major. So for many years, the provision was being slept on. So whenever you receive a gift of whatever nature, they were not taxed. And people started abusing it. So government said, no, we have to tax gifts. But how are we going to tax gifts? That is very, very important. So this table here that you see on the screen is summarizing how to tax your taxability of your gift. Where you receive a sum of money for no consideration. If I am working and I am receiving a money, then it is in compensation for the consideration of work that I have provided. If I am receiving a gift, means I have not given the other person anything in return. I am getting a gift. So, where I receive a sum of money without consideration in excess of rupees 50,000, this is the important point, in excess of rupees 50,000, then the entire sum becomes taxable. I receive a gift of rupees 45,000. It is within 50,000, so no gift tax. I receive a gift of 75,000. It is more than 50,000. So therefore, the entire 75,000 is taxable, not 25,000. It is not saying the difference between 50 and 75. If it exceeds 50,000, then the entire amount becomes taxable. Similarly, like in the previous case, you received money, you received cash. In the next case, you're receiving an immovable property, land or a building without consideration, and the stamp duty value exceeds rupees 50,000, then that stamp duty value of the property will also be taxable as a gift. The third point, both the above cases, for inadequate consideration, you are receiving an immovable property. What does that mean? I getting a property, let's say from X person, I'm paying rupees 20,000 for the property. The property is a house in Boat Club Road in Chennai, the most poshest area. Actually, it is worth several crores. But how much I am paying? 20,000. When department is coming and saying, "No, have you paid consideration for the gift? Have you paid consideration for this transaction?" Yes, sir, I have paid 20,000 rupees. I have paid. Then government realized people are saying they have paid. So without consideration means we can tax. But here there is consideration, but it's inadequate. It's clearly a case where somebody has got a gift in nature. They are trying to say they paid only 20. So they said, if your stamp duty value exceeds the consideration that you have paid by rupees 50,000, that is, my stamp duty value is 1 crore, my consideration is 20,000. If the difference between the two is exceeding rupees 50,000, then straight away that becomes also taxable as a gift for you. And finally, any property other than the immovable property without consideration also, if the fair market value of such property exceeds rupees 50,000, then that also becomes taxable. Now it's very important here that we understand what is this meaning of any property. The last line in this table, any property other than immovable property without consideration. What do they mean by property? Immovable property we have already covered before, building, land, that is covered in the second line. Why in this last line you are saying any property other than immovable property? Definition of property is given clearly. It's a restrictive definition. That means only whatever is specified here, that will only be considered to be property. So therefore, immovable property being land or building, shares or security, jewelry, drawing, painting, sculptures, works of art, and bullion. So they have given a limited definition. So let me ask you some questions. What if I receive the following? I am receiving a wristwatch from my friend on birthday. What watch is he giving me? He is giving me a regular Titan watch. Is it taxable? Now we have to again look at the definition of what is property. Property, as I told you, is a restrictive decision, is a restrictive definition. Does wristwatch come here? No. So therefore it is not taxable. What if it is a Rolex? Earlier I said it's a small Titan watch, a regular watch, nothing very special about it. But he is giving you a Rolex watch. Then also it does not form part of here. It is not jewelry, it is not drawings, it is not painting, it is not bullion, share, security, immovable property. Therefore, even if it is a Rolex watch as a gift, it is not taxable. What if it is a car? I'm getting a Maruti 800 on my birthday as a gift. Again, we have to go back to property definition. What does property say? Does motor vehicle come here? It does not. So if I get a car, if I get a bike, in both cases, it is not taxable. What about a laptop? I'm getting a laptop as a gift. It is worth several lakhs. Will that be taxable? I'm getting a new Apple laptop. Again, I direct you to the definition of property. Therefore, coming back to this table, when you look at that last line, any property other than immovable property without consideration, it has to be only these type of property. If it is any other property, that does not fall in this definition, then you don't have to worry about gift tax. It is not applicable to you. The next question you may ask, Sir Abhishek, you're telling me all this is taxable. When my father gives me a gift, when my mother gives me a gift, I don't offer it to tax. So many years I have not done. So they give me a gift every other day. How can I pay tax on that? So there are certain exemptions to who is not taxable and what sort of gifts are not taxable. Where I get a gift from a relative, that is not taxable. Where I get a gift on the occasion of a wedding, I'm getting married, not engagement, not any of the other sangeet and none of those conditions. If on the occasion of wedding I'm getting it, that is also not taxable. It is exempt. Gift received under a will, gift received during a partition of HUF. In all of these cases, whatever gift, whatever is the nature of the gift, it will not be taxable. But here, as I told you, you are getting a gift from your father, you're getting a gift from your mother, it is not taxable. Gift from relatives is exempt. But when we see relatives, we have to see the explanation and definition of what is relative also. We cannot say my third cousin's first brother, he gave me a gift. My third cousin's spouse's third brother, he only gave me. They are very distant relative. Very common. I think in school also we would have heard where you will say, he is my distant relative. All that is very, very commonly used terms in India. So, because of that, it's important for us to define who a relative is. So, a relative here is normally a close relative, spouse of the individual, brother or sister of the individual. I am getting a gift. If I get it from my spouse, it is exempt. I am getting it from my brother, sister, it is exempt. I am getting it from the brother or sister of my wife, that is also exempt. I am getting it from my parents, exempt. I am getting it from the brother or sister of my parents, that is aunt or uncle, not first cousin. It has to be own brother, own sister of either of my parents, that is also exempt. Any lineal ascendant or lineal descendant, my grandfather, my great grandfather, my son, my grandson, any of them are giving me a gift, all of it is exempt. Similarly, same thing applies to your spouse also. So when you get your gift from these people, it is exempt. So definition of relatives is also fixed under the act. Let us come to lottery winnings. Let us tackle lottery winnings. As I told you, when you get any gambling or getting winning from lotteries, also it is taxable under income from other sources. But when it comes to your lottery winnings, it's a very, very peculiar provision. What do I mean by peculiar provision? It's very important to understand. Whereas all the other cases I told you, be it your interest that you're earning, be it the dividend that you're earning, be it a gift you're earning, everything is taxable at your slab rate. And when I say slab rate, that means 5%, 10%, 20%, 30%, whatever slab rate is applicable to you, it will be taxed at that rate. But lottery winnings is slightly different. You see, there is a section called 115BB. If you have any winnings from lotteries, horse racing, where horses are racing, card games, even crossword puzzle, and any games of that sort, that will be taxable under section 115BB. And why is this section different? While in all other cases there is a slab rate, when it forms under any of these items, then it will be taxed at a flat rate of 30%. You can say my income is only 5 lakhs. I am only subject to 5% tax. How can you put 30% tax? You are right, you are subject only 5%. But if you have winnings of lottery, if you have card games winning, then all of that will be taxed at the rate of 30%, not 5%. Now, next you may ask, what if I don't have any income at all? I'm a retired person. I don't have any income. I go and gamble with my friends. I go play cards with them. I'm earning 50,000 rupees. So you can ask 50,000 rupees I'm earning. It is within 2 lakh 50,000, the basic exemption limit. In India, up to 3 lakhs if you earn, there is no tax. Up to 2 lakh 50 is a basic exemption limit. So if I'm earning only 50,000, I have no other income. I don't have any form of income. So only 50,000 rupees I'm getting as gambling every year. Do I have to pay tax? Yes. 115BB is a peculiar provision where it says You will not have the benefit of basic exemption limit also. I don't care if you're a senior citizen, I don't care if you're young, I don't care whether you're not earning any income. If you get income from cards, card playing cards, you get income from winning lottery, you get winnings from horse racing, in all of these cases, without seeing what your other income is, we will tax it straight at 30%, and that is what this section holds. There's also a very interesting case where Dr. M.A.M. Ramaswamy, a very highly esteemed persons in India, the late M.A.M. Ramaswamy, there was a case where he asked, can we set off the loss and the expenses incurred against this? I have a loss from business. I made a lot of winnings from horse racing. Can I set off my winnings from my racing against my loss from business? No. Again, this provision is peculiar. It says whatever winnings that you're getting, bring it to tax. Whatever expenses you may have, whatever losses you may have, you cannot enjoy any of those benefits. That is why this is very peculiar. Even your chapter 6A deductions. I have put my investment in PPF. I have put LIC premium. Can I set off that chapter 6A investment, tax saving investments, irrespective of how much amount of tax saving investments you have? You cannot set it off against your winnings and income from gambling, lotteries, horse racing, and crossword puzzles. It's a very interesting case. We all know the very famous Formula One racer from our very own Tamil Nadu, Narayan Karthikeyan. Very famously, he drove in Formula One. So there was a question that came up in his father's case, where his father was also a racer. So in his father's case, he was racing, and what happened was he won some money in the prize money he won. And then this case went up to the court, where the court said, this is also a gaming. They said, no, no, I have applied my skill. It is not a random game where by chance I am not winning. I have applied my skill. I have applied my professional expertise in winning it. Therefore, it's a endurance. Therefore, I won the money based on applying skill. It should not be taxed under this lottery winning. So I should not be subject to that 30% tax, is what he said. Then you have to look a little deeper. If I'm someone who professionally races, like Narayan Karthikeyan, he professionally races, then in that case, you're continuously doing that activity. So displaying skill or endurance in those cases will be your business income or your professional income. But where I'm occasionally doing it just for jolly, I have a friend. We both decided on one day we are talking. I'm saying I'm a faster runner than you. He says, no, no, I can run faster than you. I said, betta, coming, 1,000 rupees, we'll do a bet. We'll both of us will run and see who wins. And I win the race and I win 1,000 rupees. Then in that case, I have still applied skill. I have still shown endurance. It is not by chance that I'm winning. By having a faster, I've been training, I have strong legs. Because of that, I'm able to beat him and win the race. So I win the money using my skill. So in this case, will it be my income from business? Will it be my income from profession? No, because my profession is not running. I'm a chartered accountant. I was just talking with my friend and we entered into an agreement. We said we both will race and we will see. So therefore, that running race will also be considered to be a winning under this lottery winnings section, and it will be subject to 30% tax. Just like that, in CIT versus GR Karthikeyan also, the same thing happened where it was held that it was not a business activity, it was not a professional activity, it was still a competition winning, therefore it should be subject to tax under this section. One interesting other case. Now, you may hold an NSC certificate. NSC occasionally they have this prize winning where they will spin the wheel. They'll see one of the NSC holders, they will draw out of the box, and whoever wins that, they'll get a prize. So once they had a car as a prize, Maruti car was there as a prize, and they took a draw from the lots. One madam called Sugana Seelan, she won it. Sugana Seelan won because of this draw of lots. She got the Maruti car. Income tax brought that car to tax, saying it is a lottery winning. By draw of lots, you have won it. So this went up again all the way to the Madras High Court, where they held that in order to be a lottery winning, in order to be a competition winning, somebody else also has to put money into it. If 20-30 people are participating, 20-30 people will put some money, they will buy a lottery ticket or they will put a deposit, and then if they win, the collections from everybody will be given to me. In NSE case, none of the NSE holders put money towards this cause. NSE themselves announced it. There was no contribution made from the participants. It was a free chance. It is not a paid chance. Therefore, it is not a lottery. It was not a lottery. Hence, CIT versus Suguna Sealand, she was not taxed, even though she won in a draw of lots, since none of the participants contributed to this prize money. It was held not to be a lottery. These are two critical points. And finally, I come to pension. When most of us are earning pension, even though we are no longer in employment, even though we are no longer in employment, there subsists a relationship between the employer and employee. So I am earning the pension technically because of my long-standing relationship with my employer. It is considered to be income from salaries. But what if I die? What if I die? Then my wife, my kids, they will take the pension on my behalf. In this case, it is known as a family pension. As long as I am alive, that employer-employee relationship still stands. But the moment that person who is receiving the pension is no more, somebody else is collecting it, that person cannot step into the shoes and say, I am also an employee. That relationship does not exist with the other person. So therefore, if your wife or your children, you are receiving the pension on behalf of the person, then that will be taxable under income from other sources. And why is this important is there is some level of deduction allowed when it's a family pension. When I'm collecting the pension because of my late husband, or I'm collecting late pension because of my late father, then in that case, up to rupees 15,000 or one third of that pension amount will be allowed as a deduction. Whichever is lower will be allowed as a deduction. So you can reduce that, and on the balance amount you pay your tax. It's enough. So I think these are all certain additional points which are not very important. I've just tabulated it. The final slide, I will just talk about few common instances that you will find. Withdrawal from PF, whether it's taxable, because especially now, given the COVID situation, many people ask the question whether it's taxable. Government have announced that for now there is no tax on withdrawal from PF, but normally, how is withdrawal from PF taxed? You see, there are three components when it comes to your PF. One is your employee contribution to the PF. I am also contributing to the PF. Your employer contribution to the PF. Then the interest earned on the employee contribution, interest earned on the employer contribution. Here, your employee contribution, whatever you're earning as an employee on your contribution to your PF, then in those cases, this amount that you have contributed, amount contributed by you to your EPF, this portion, whatever you withdraw, is not taxable. Similarly, similarly, if your interest, whatever interest you have earned from your contribution to the PF, is that taxable? Yes, that is taxable under your income from other sources. Your employer's contribution, your employer also contributes to your PF 12%. Now, because of COVID, they're contributing 10%. Is that taxable when you withdraw that portion of it? That portion and the interest, both the contribution and the interest, is fully taxable when you withdraw it from your PF fund. So that is how your withdrawal from PF is taxed. Your awards in public interest. Many often you see Arjuna Award, Nobel Prize, all of this is there. So wherever the government of India gives an award in the public interest and any amount is received because of that award, that is not taxable because it is an award given in public interest by the government itself. It has to be the specified award. Then in those cases, you will not be taxed. Income tax refund. If I'm getting an income tax refund, is my income tax refund taxable? No, my income tax refund is not taxable. But if I'm getting any interest on that income tax refund, that is taxable under the income from other sources. I think as far as subletting is concerned, the earlier speaker already gave you an example. and said that subletting of a house will be considered as income from other sources because there is no ownership of you. The owner is somebody else. For income from house property, you have to be a owner. So therefore, I am subletting it means it is an income from other sources form. So with this, we have come to the end of my presentation. I have, of course, covered few more aspects in my PPT here, and I'll be more than happy to share the PPT with you. If you may send me an email, I'll be more than happy. You can note our email ID that I've put on the screen, and that will be practically useful also. Many case laws are also there. So maybe we can take a few questions now. Thank you so much for allowing us to giving us this opportunity to present. And we will take a few questions here so that we can learn more from deliberation and discussions. You can comment your questions on the chat box. We can flash it on the screen and take up the question that whatever you are asking. PF withdrawal after retirement with service of 15 years, is it still taxable? Yes, it is still taxable, but as I told you, the way of taxation I have prescribed. I will share the PPT with you. You can always refer back to it to see how that taxability arises.
How much money you have put in your property from your contribution?
I
I
think
think the question is not clear,
maybe
but
you can just reword the question and ask.
typically, if you are buying your own house property with your own funds, then you cannot take the deduction that will be that interest from borrowings that I covered in detail. You might not be able to avail those deductions. There were some questions on gift at the start, where if you gift something to your own child, will it be taxable? Like Abhishek had already covered, we responded that when you take a gift from a relative that is covered under that, the same will not be taxable.
Any more questions? You can feel free to ask. We'll be happy to take it up. Sir, our maternal grandparents are also relatives, and gifts from them, is it taxable? As I said, the definition of relative is very, very clear. They give the exhaustive definition. So, any lineal ascendant or any lineal descendant, that means in my line of my generations, if anybody is there, my father, grandfather, great grandfather, that goes upwards. Similarly, downwards also, my son, my grandson, my great grandson, anybody in this line, my line or my spouse's line, in both the cases, it will not be taxable if I receive a gift from them on whatever occasion, whether it is wedding or a normal day also, whether it's a normal Monday, Tuesday also, it will not be taxable.
If rent is not received for 2 months, how is it taxed? Supposing you have not received rent because of vacancy, that is, your tenant has vacated and because of which you have not received rent, then you can claim that as a deduction. That is, you do not have to pay tax on that rent for the 2 months that you have not received. With respect to Corona, I have specifically covered during the course of my presentation, where if you have an agreement to that effect, then you can still avail the benefit of not paying tax on it.
The money received from a minor's account, is it taxable? So here there is actually technically this. I will answer this question because a very interesting point. It involves something called clubbing of income. So where the minor receives the money from application of skill by them, then they'll only be taxable. For example, that Mani Ratnam movie Anjali is there, where you have the lead actor is a child. or Kanatil Muttamittal, the lead actor, she's a child. She's earning the money because of application of her skill. Then she will only be taxed of the income. But suppose I am putting a fixed deposit in the name of my child. My child does not earn the money out of skill or anything. They just happen to be my child, so I put the fixed deposit. They are earning interest on that. Then it will be clubbed with my income, and I will show it as income from other sources. That is how it will be taxed when you earn income from a minor. Okay. Same question somebody else has also asked. Presumptive
Okay.
income, I think we'll have another separate session
We
for
will be
that.
covering this falls under income from a profit or loss from business or profession. We will be covering this in detail. You
It's a
can
very,
watch
very
out for the
important
same.
thing in your income from business. We'll definitely cover that in another program, not for today. Amount got from TV shows or any sort of program, does it come under income from other sources? Yes, it comes under income from other sources, unless you are in the regular activity of appearing on the TV programs or earning it on a regular basis. Then it can be considered to be your business income also. What is important is the frequency of the activity. If one day they are calling you suddenly saying you come and speak, there's a fire in your building, so they're calling you and they're saying come and talk, we'll give you 5,000 rupees. That will be your income from other sources. If every day you are speaking on the TV as a reputed speaker, then it can be your income from business.
How is unrealized rent recovered treated? Excellent question. In fact, with the amendment in financial 17-18, whatever unrealized rent you receive at a later date, in the year in which you receive, you will have to pay tax on it. But additionally, you can claim that 30% standard deduction, and then on the balance 70%, it will be taxable.
Dividend is taxable at a separate rate or included in the normal tax rate. Till the current year, it was taxed at 10%. However, from this year onwards, it will be taxed as if it's your regular income, as if you're earning interest from fixed deposit. You don't have any exception and all. It will be taxed at your slab rate only.
If the house may be given for lease, what is the provision? This is something that I covered in detail where I said anything that is let out, property that I use the word let out will fall under this lease provision. So whatever rent you get from the let out will be taxable.
Gold received during marriage. As I told you, when you receive any gift on the occasion of a wedding, it is not taxable. Therefore, you don't have to pay tax if it's received on the occasion of a wedding.
This yeah. Whether the rent received from commercial work premises comes under house property or business. Again, good question. It comes under house property, irrespective of whether it is residential or commercial, it will still form part of the house property income. If we have taken bank loan for house purchase, what are the benefits? Is there a slab to them? This also I had covered in detail. I'll be happy to share my presentation. Typically, if it's a let out property, whatever interest you pay will fully be deducted. If you're a self occupied property, then there is an overall limit of rupees 2 lakhs that you can take for the benefit of deduction.
Winning cash through TV shows, will it be taxable? Yes, it will be taxable. As I told you, under that 115BB special provision, it will be taxed at the rate of 30%. What the provision actually says is whether you win your money through competition or prize winnings, competition winnings, whether it is on a regular mode or even electronic mode, whether it is on internet, TV, radio, whatever it is, it will still be taxable. So yes, winning cash through TV shows will be taxable.
How many houses can be self occupied? From financial year 1920, you can have up to two houses. It's a landmark amendment. Before that, up to 31st March 2019, you can take only one house as self-occupied.
Sometimes parent may put dividend in the name of minor child. Is it taxable? Any income that is earned from the minor child will be clubbed in the hands of the parent, irrespective of nature of it, except if it's earned by the professional application of skill by the child.
Yes,
Yes,
this will be available.
the same video link. In fact, you can rewatch this video or you can share the video also. It will always be available. You can subscribe also if you like to get further updates.
I'm the owner of house. My municipal tax is 5,000. Tenant paid 3,000. The act clearly says only the amount paid by owner. That is, in this case, you'll be paying only 2,000 rupees. So up to 2,000 rupees on the date of payment, you can take a deduction. Whatever the tenant has paid, unfortunately, you cannot claim as a deduction.
This child includes stepchild, adopted child, etc. So yeah, the act is not clear on whether stepchild, adopted child, but a child you would assume is the same, will take the place of whatever nature your child is. So yes, it will be included. Whether a gift received from guardian is also taxable, because a guardian does not fall in the definition of lineal ascendant, lenient descendant. You may not get the benefit of exemption from a gift from this person. However, if they don't have a father or they don't have a mother, and the guardian is only looking after the child as if it is their own child, then in that case, it may be considered. It may be looked at from a case to case basis, but the act itself prevents any such thing because it can be misused. Because today X can be my guardian, tomorrow Y can be my guardian, day after tomorrow Z can be my guardian. I can keep changing. So, guardian is a very broad term. You have to see the facts and circumstances of each case. What if I receive a gift of gold chain from my employer for the work of excellence or the silver jubilee of the company? Is it taxable? It's a,
So,
yeah, it's a good question. This may be forming part of perquisites that you're receiving from the employer. So they themselves will
okay.
reduce the tax and they will offer it to tax. So it will be taxed if it's received from your employer. They themselves will likely tax it.
I think most of the questions have been answered. Gold received during marriage.
If gold received during marriage is huge from parents, does parents have to show any proofs? If it comes up for scrutiny, they may have to show proof. So if you receive a notice from the income tax where they require you to do it, in fact, we handle cases like this on a day-to-day basis where we go to the income tax. And of course, it depends on the case. It's easily possible for you to justify. Even if you can't justify, there are various case laws which say that accumulation of gold over a period of time also is acceptable to a certain limit. Of course, again, it has to be evaluated on a case-to-case basis. You can always just message me any particular questions you may have on that matter.
Usually only one house allowed, but now two house owners. No, is this condition? The primary condition is if you are moving because of employment, owing to which you have two self-occupied properties, then it will be considered self-occupied property. Again, I go back to my presentation where I clearly describe what falls under self-occupied and what falls under let out. So as long as you go by those conditions, you can still avail the benefit. Yeah.
I think we've covered almost all the questions. So thank you so much for this opportunity. I hand over the session to Sujata ma'am to propose the vote of thanks. And,
Thank you, Abhishek sir and Divya ma'am. It's a wonderful session. It gives more information and ideas, particularly on interest on borrowed capital, unrealized rent and arrears, income from other sources, then taxable of dividend income, particularly on gift, what we had been received and what we had given. Thank you for the wonderful session. Thank you, sir. It's time for thank for our management, our secretary, Madam Kokilam Kumanan, Chairman, sir, Dr. Sedu Kumanan, our principal, Madam Dr. Shamshed, who permit us to conduct this program. I thank all my department staff who are always with me. I thank all the participants who make program as a grand success. Once again, I thank you, sir. One instruction for the participants. We will chat the feedback form now. You can fill the feedback before 6 o'clock. We will issue the certificates within a week or at the end of the next week. Thank you, sir.
yeah. The feedback form is available in the description if anybody is interested.
Yeah.
Okay, sir. Can we want to you want to share in the chat box also, sir?
Yeah, I
Yeah,
already shared, but we can share again.
we'll share it
at the
again
end.
because once
Okay.
the session ends, the chat box will not be visible. We'll put it in the comments also for people to see. So thank you,
Okay.
thank
Thank
you.
you.
Thank you all. Thank
Thank
you.
you, sir. Thank you.